Welcome back to Lunch Money. Ajay Bodke, CEO and Chief Portfolio Manager at Prabhudas Lilladher, joining us on the show. Afternoon, Ajay. Thank you for being with us. How are you reading market movement right now? Despite any global news flow that you've had, markets have maintained their positive momentum. Nifty sitting near a 52-week high, and all indications showing that possibly we are heading towards record high levels again. What's your reading of the market movement?
Yeah, good afternoon. I think the upsurge in the Indian markets essentially is underpinned by a torrent of flows coming from the FIS front over the last month. I think roughly $25 billion has flown into the emerging markets, and a significant portion of that has come into emerging equities. And emerging Asia has been the largest recipient of those flows. So I think India has been a beneficiary of these flows. But let's juxtapose that against the stance that the domestic institutional investors have taken. I think those flows have come down to a trickle. And there is an understandable caution among the domestic institutions, because the valuations have started to look sort of, somewhat daunting, in my opinion. I think, post-budget, there are 4 or 5 triggers that the market was looking for, in addition to the adherence to fiscal consolidation by the government. And almost all those issues, I think, have come to fruition. I think after 2 years of drought, we have got a bountiful monsoons, a good temporal and spatial spread we have got, expected to lead to a sharp jump in the rural demand post-harvest in October-November. That's been discounted, in my opinion. The 7th Pay Commission award, I think the check should start flowing in soon. That boost to urban consumption also sort of, has been discounted by the market. And then thirdly, I think you're looking at the passage of long-pending GST bill. I think tomorrow is the D-Day. And the expectation is that I think the constitutional amendment bill should sail through. Now, in addition to that, on the global front, I think as the weak economic data from the US clearly demonstrated yesterday, I think any lift-off of rates looks unlikely anytime soon. And till December, markets can breathe, December 16, markets can breathe easily. So I think there's a confluence of both global and domestic factors that have led to this upmove in the Indian markets. But then you contrast that with the earnings season. And what one clearly sees is that the earnings season till now has been patchy, to say the least. There are certain pockets like cement which have done very well because of cost curtailment measures. But even there, when you hear conference calls, I think the demand uptick is only expected to happen from rural housing post October-November. And the pricing power also is expected to come back then. There are certain pockets in consumer sectors like paints or home improvement companies that have shown very strong and resilient double-digit growth. And in case of paints especially, one has seen gross margins holding up because of fall in crude prices. But the mainstream FMCG companies, be it Dabur or Levers, one clearly was expecting 6 to 7% growth in volumes, and there one has to remain content with 4 to 5% growth in volumes. Again, we are hoping that, with the 7th Pay Commission and rural demand post-harvest, I think that volume growth should pick up. Banking, the biggest of them all, I think a story of contrasting halves. We are seeing retail-focused banks continue to chug along at 25-30% credit growth, strong NIMs, asset quality being pristine. I'm referring to banks like HDFC Bank, IndusInd Bank, but corporate-focused banks, both public and private, there is no end to the addition or accretion of fresh slippages out there. A good 1 or 2 quarters still we got to wait till the bottoming out process happens out there. IT has been a complete disappointment with the exception of Hexaware, I would say, which is a mid-sized company. And pharma till now again has been a disappointment. So when one looks at, when one takes a holistic perspective of the earnings profile, I think it's we are again kicking the can back into the second half of the year and expecting, like we expected over the last 2 years, that the earnings growth should come back roaringly. So I think when one looks at from a holistic perspective, I think the market is now approaching levels where one must refrain from being adventurous and be very, very selective in what one is buying now. Otherwise, one could regret when a correction comes our way, and that the trigger for that actually no one can really point out.
Okay, so Mr. Bodke, that was a pretty comprehensive take that you've told us about, including the mention of those stretched valuations as well as what you've called patchy earnings, which is of course something that's been of grave concern. Now, given the kind of environment that you've talked about, and also the fact that we're still waiting for certain triggers, if you were to be selective, would you be selective according to a few sectors, or are you looking at specific companies? Where would you be placing your bets going forward in this environment?
Yeah. So I think, as I said, first and foremost is quality, quality and quality. Because, as the valuations start becoming daunting, I think one needs to be extra vigilant in what one is buying, because in the event of a correction, I think one needs to be very cautious and pick up those franchises which have the ability to withstand that fall, and even if they were to fall in consonance with the market, have the ability to come back when the market sort of steadies and starts moving up. So that's the first advice I would offer investors. The second thing is, among the sectors that you asked, I think I'm very closely watching the result season, and one sector that stands out is cement. As I explained in detail, I think a lot of companies have curtailed their cost by moving to pet coke usage, by right sizing the personnel costs and the other freight costs, logistics costs, but they are yet to benefit from an improvement in strong volume growth as well as pricing power. So our expectation is that post harvest, I think these companies would stand to benefit the most from a upsurge in rural housing demand, in addition to the government spending on roads and railways, which should aid volume growth again there. So companies like ACC, or in the mid-cap space, a company like Heidelberg Cement and JK Lakshmi Cement, which even today are trading at a reasonable EV per ton as compared to the biggies, and which have shown very strong margins, as well as they have the capacities in place, are the ones that I would look at. The other space that I would continue to look at is retail-focused private banks, because that's where the growth is, and I would be willing to pay a premium to buy that growth, rather than getting into an environment where the fresh slippages and sales to ARCs continue to dominate the corporate-focused private banks' results. And there is, in my opinion, at least a quarter or two till the bottoming out process happens. So a cheap will continue to remain cheaper, and the expensive will continue to remain or trade at a premium, in my opinion, till the growth continues. The other sector which has underperformed the market over the last 6 months, and where I think there are some values available, is the pharmaceutical sector. Now, we have seen multiple headwinds buffeting this sector over the last 1 year or so, including US FDA's insistence on certain remedial measures being carried out in certain plants. But there, I think we are hitting a spot where the valuations are turning reasonable. The pipeline of A&A approvals in many of these companies continues to remain strong, and the genericization in US and other developed markets continues unabated. So one needs to be selective out there. In the mid-cap space, there are 3 franchises which I think one should look at. Among the larger ones, Aurobindo Pharma, I think, is what we prefer. In the smaller ones, I think Jubilant Life Sciences, which is focused entirely on, majorly on radiopharmaceuticals, and has a niche positioning out there, continues to look good in the medium-term perspective. A lot of approvals are expected for that company, including RubyFill, which should come in third quarter, which should be a blockbuster product for them. And Glenmark Pharmaceuticals, which has had some headwinds because of currency issues in Venezuela and Brazil, but the company has provided substantially for those. The US generics business continues to remain under pressure for all the companies, but the new product launches should be able to alleviate whatever pricing pressure one sees in some of the old generic products out there. So I think this is a pack of Aurobindo, Jubilant Life Sciences and Glenmark Pharmaceuticals, which has been subdued over the last 6 months. Valuations are reasonable, a good product pipeline is in the offing, and I think investors will start gravitating some money as they take some risk off the table from the NBFCs of the world and from the some of the high performing sectors, and start putting in money into some of these companies where valuations will look very reasonable.
Right, Ajay, Ajay, comment on some of these IT names. Of course, large cap IT hasn't done much as far as earnings are concerned. Infosys, a big crack coming in, guidance concerns on the counter as well. But do you see value in some of these mid cap IT names out there, or possibly some other mid cap space, possibly mid cap cement or some of these mid cap PSBs? Is there any valuation play in some of these sectors?
I think in the IT space, the biggest disappointed Infosys. So yes, I think, but at the same time, I think the underperformance in Infosys sort of, is, in my opinion, making me now having a look at the stock with a medium-term perspective, because the medium-term outlook for the company and the strategy of Dr. Sikka continues to enthuse the market. And I believe that I think if one is willing to take a 15 to 18 month view, then it is now reaching levels where investors can start nibbling into that counter. On the mid-cap IT space, I think again there has been a general disappointment with the numbers, with the exception of a couple of them, and Hexaware stands out head and shoulders above the others. I think the company delivered a very strong dollar revenue growth of around 6% in the second quarter. They had guided for a strong second and third quarter, and they've delivered there. I think there was a bit of concern when the results were announced about the miss in margins, but in the conference call, the company clearly enunciated that there were 3 one-offs, and if you were to add back those one-offs, then the margins would have been higher by around 2.6%. I think they spent $1 million on their Shrink IT, which is a new offering that they have, and this was the money spent on advertising and branding for that process. The second one, I think the visa costs were significantly higher than what the market had budgeted in, and which will not repeat in the third quarter. And the third thing was that the utilization was 2% lower, which is expected to again go up in the third quarter. So if you add back these expenses, $1 million in Shrink IT, $1.3 million in visa costs, and a lower 2% utilization, and then adjust for it, then I think the margins would have been significantly higher, as I said, around 2.6%. And the company guided that not only will the third quarter be strong, but the entire second half, that is the fourth quarter, also will be very strong. Company's year ending is December. So I think this is one stock where I feel that investors should look at with a medium-term perspective, and there I think I see tremendous value in the mid-cap IT space. I already spoke in detail about some of the mid-cap pharma names like Jubilant Life Sciences or Gledbach Pharma. I think the other space I would like to talk about is, and I also spoke about mid-cap cement names like Heidelberg Cement and JK Lakshmi in particular. I think in case of some of the FMCG names, Britannia, I think continues to look quite strong. Strong expansion in the northern and the eastern part of the country, where the presence is comparatively weaker as compared to west and south. And the product profile is also improving, margin improvement is happening. So there is some concern about rising raw material costs, but the company should be able to alleviate that, I think, through cost efficiencies. So I think Britannia also, the medium-term perspective, looks quite attractive.
Ajay Bodke, CEO and Chief Portfolio Manager at Prabhudas Lilladher. A pleasure having you right here with us on Lunch Money on this Tuesday.